Okay, Mega team, welcome back to the channel, guys. Thanks for tuning into today's video. We're going to go ahead and take a look at Bitcoin. Now, Bitcoin has been performing exceptionally well in the last couple days. We saw a significant bounce, guys, from that 18,600-ish range all the way up 16, 15% upwards, even higher to $22.4 thousand, just under $22.4 thousand, and we've since rejected. We're going to talk about all that. We're going to talk about the CPI. We're going to talk about the Bitcoin dominance. We're going to talk about the macro. We'll talk about the 9-year trend line. We'll talk about the short term. Today's going to be a longer video, but we're going to talk about everything we need to know so we are best prepared heading into the economic news, which should be releasing in just under 48 hours, if I'm not mistaken. Anyway, guys, before we get started, head over to the pinned comment, click the link, join our Telegram channel, get access to all of our updates, analysis, and much more over here. All our videos, all our posts, informative posts, and if you're interested in our VIP, of course, you can get access to our VIP channel right over here. We post daily trade signals, updates, analysis. We've done over hundreds and hundreds of % profit already this month. Very, very few losses, a lot of wins, which is always good to see. Let's go ahead and get stuck into it. So we'll start with Bitcoin dominance. And I want to talk about Bitcoin dominance because this is probably the most, first off, the easiest thing to talk about in today's video, but also it's not going to require a lot of time, but it also is a really important thing. We're seeing Bitcoin dominance bounce from the 39.26 horizontal support and push back upwards to the 41 major horizontal resistance, 41% level. And we can attribute this, obviously, this pump upwards to Bitcoin's move upwards. Obviously, Bitcoin's really taken a lion's share of the market, left a lot of altcoins behind in the dust, guys. Bitcoin's gone up 20% from that bottom and left a lot of altcoins in the dust. So it's Ethereum in the dust even. It's really pushed forward and it's reclaimed a lot. You know, we're down at 39, even down at 38, a 5.5% move in Bitcoin dominance in 3 days or whatever it was, 4 days. Significant, very significant, but we're at massive resistance here. As you can see, this 41% zone has acted as a significant resistance. I wouldn't say a massive resistance, it's horizontal level, because this is a zone. In fact, it expands upwards to about 41.5, as you can see over here. But it's an initial resistance. It's hit an initial resistance here at 41%, and we can expect, obviously, if we get rejected here, we can expect Bitcoin to suffer a little bit, maybe head down, maybe share some of that percentage profit, share some of that percentage capital, should I say, with the rest of the coins provided the total cryptocurrency market cap continues upwards. So let's hypothetically assume Bitcoin dominance drops from here at resistance. If it drops, we can see money flow out of Bitcoin, flow into other crypto assets, provided that the total cryptocurrency market cap continues to rise. If the total cryptocurrency market cap falls down from here and Bitcoin dominance falls down from here, we're going to see a lot of blood in the market again, okay? And we have CPI coming up, we have Ethereum merge, we have Fomo, we have the deadline from Mt. Gox. We have a lot of stuff coming up in the next few days, and I would say Bitcoin's in quite a delicate position. We'll talk about that one in a second. Total cryptocurrency market cap, as we can see, we talked about this one last time. We had a nice strong bounce on the 2017 all-time high. We pushed upwards. We claimed this resistance zone. We pushed upwards. We got rejected. We're back down. We're kind of in the middle of the range. So in terms of total cryptocurrency market cap, we haven't made any progression here, significant progression. Like I said, with Bitcoin dominance flying up, although Bitcoin has gone up, the rest of the market hasn't moved much. We've seen stagnation in a lot of altcoins. A lot of altcoins are only up a few percent. We've seen some altcoins do really well. Atom, per se, up 30%. Ethereum is not doing too badly, 15%. But for the most part, a lot of altcoins are massively lagging. And this is not a good thing. This is not a good thing. This is not what we'd like to see, but we'll talk about that later on in the video. So let's get into Bitcoin. For let's go on the weekly chart. Let's start on the weekly chart. And of course, this is our weekly chart. This is the 9-year trend line, okay? It does expand backwards, but for us, a 9-year trend line, the massive support line we do want to hold for us to be bullish. And again, this is the line that we expected the bottom to be at in June, and since then we haven't actually swept that low. So far so good. Our bottom prediction has been perfectly accurate. We haven't swept that low yet. And we're going to quickly summarize this. For us to go to new lows here, guys, we do need to lose this level, okay? We are not going to new lows unless this horizontal support line is lost. If that horizontal support level is lost, if that 17,500, whatever it is lost, we do expect the price to continue downwards to new levels. Those new levels we can show you on this chart will be between $12,000 and $13,000 if that level is lost. As you can see in this chart over here, we do have a huge, and I mean huge, block of support below us. This isn't a small block. This is a very, very big block. Let's go ahead and bring up the VPR. You can see, even on the VPR, guys, we do have a lot of support down over here. Okay, it pushes upwards if I go ahead and expand. It doesn't necessarily say we have much support over here, but we haven't spent a lot of time in that region to really develop that support. So the VRPV shows us historical trading volume within certain price points. And because we haven't spent a lot of time within this range, we don't really see that on the VRPV right now. It doesn't suggest that we have these huge amounts of support in this range, but we do have it there. It is there. It will come if we do drop to that level. And we've seen it start to develop already, as these chunks were not present a few weeks ago, as the prices delved into this level, found a lot of support at these levels, these horizontal supports, this horizontal support range, and pushed upwards. So worst case scenario, guys, we flip the trend. CPI comes out really bad. Economic news is bad. Now Gox dumps more. Ethereum merge goes negative, goes south. Everything bad news. What happens? Well, the trend could reverse. We head back into this range. Of course, we're not hitting a new low until this level breaks. That would trigger us move downwards. Possible scam wick to 16,000. If we lose 16,000, that's our trigger to this level. Really simple, okay? Bullish until a weekly close occurs underneath this this 17,000 level. We lose the 17,000, or we close below that 16,000 level, heading us downwards to a new low. Okay, so that is the downside. The upside is more likely. I'm not gonna lie, I've been more bullish than bearish this entire time on the way down. Obviously, for those of you who have been following me for a very, very long time, you would already know where we call the top. We call the top right over here, guys, on that trend line touch. We told you guys we're heading down to the 200-day moving average on the weekly. That was sitting around 22,000. And then when we lost that, we said, guys, we're going to bottom out, just like we have bottomed out 2 other times on this trend line. And we did, in fact, see that play out. We perfectly predicted it. Ever since then, we've been leaning more to the bullish side. I'm not bullish, I'm not bearish, but our overall bias, what we think is going to happen on the macro, we believe we are more towards the upside until we're proven that this trend line has not been able to hold. And until that happens, it is still support, and support is treated as support until it's not. So let's talk about that. Let's talk about where you think it's going to go. On the macro, if we do push upwards from here, say the bottom is in, say we don't go down any lower, maybe we go back down, test 18,000, but say hypothetically we continue upwards here, what do we think will happen? Where do we think the next resistances are? And this will kind of bridge us into our next little speech, our next little topic, which is talking about the short term. So we'll kind of skip over the short term but come back to it. But we do have some major triggers I want to talk about. The first trigger is 22,400, this level here. The next trigger is this 23,000 to 23,800, and then finally the next trigger is just over 24,000, around 24,400. Okay, these are the major horizontal resistances above us currently. Breaking through these levels send us to this downward trending resistance. Obviously, this downward trending resistance makes up the downward slope of our macro descending channel, which is in fact our bear market structure. This is the entire bear market right here in a singular structure, the macro descending channel. Breaking past the macro descending channel will push us higher into this range. This is our first rejection range. Every single gray box we see here is an incredibly strong zone of confluence and rejection, stagnation, sideways price action, whatever you want to call it. These areas are incredibly tricky to break below and break above. Every single time we've seen the price into these levels, we've seen a long period of sideways action before we get an explosive move. And we've seen that happen not only on the downside, but as well as the upside. Every time we break through these levels, we get these explosive moves, okay? These are incredibly important levels to look at on a chart going forward for Bitcoin, whether we meet those levels in a few months or a year or so, these levels are going to remain important. So breaking through these levels was what we need to see for a move upwards. Every single time we push into one of these levels, we're looking to sell, we're looking for rejections, we're looking for shorts. Every time we push through these levels, we're looking for longs to the next level. Okay, the bull market will commence once 48K is broken. The macro uptrend The macro uptrend will be confirmed once we break this downward trend over here, okay? The macro uptrend initiates at the bottom, but is never confirmed at the bottom. The confirmation happens after the fact. After we break this downward trend, that is when the confirmation of the macro uptrend begins. Remember, buying the bottom, predicting the bottom is always a bet. It is always a gamble. You're never entirely sure in the moment. You can use paths data, price action, structures, zones to help predict, which we have done. But for actual confirmation, we do need that downward trend to break. That doesn't mean I'm bearish. I am bullish because we have a lot more support than we have resistance at the moment. We have a lot of support underneath us. Until proven otherwise, these support lines should be considered as support, and therefore you should be looking at the risk reward ratio right now, and it's more favorable going upwards. That doesn't mean the short term's bullish. We're going to talk about the short term now. So obviously, if you've had two eyes and you've been watching the market over the last week, you wouldn't be shocked to see Bitcoin's price where it is now, okay? It is surprising that we've gone up this quickly, but at the same time, guys, it was what it was. You know, we bounced from a very major, very strong support zone, which was this zone over here, the same zone we've bounced from very many times. And we were talking about this entire move here, saying, you know, this entire way down, we're saying Bitcoin is ready for reversal. This technical analysis is suggesting this trend down was exhausted. We have to see a strong reversal at some point, which is what we saw. The thing is, generally when we have excessive amount of fear, which is exactly what we had over here. We had a significant amount of fear. Every time we come close to the bottom, every time we come close to major horizontal supports, so we're talking major macro supports, not just short-term supports, we see fear skyrocket. Generally when there is fear, support lines tend to not hold very well. So generally, if we take a look over here, if we look at a little arrow over here when I'm drawing, if you see the price action moving around on a standard day, it might come down, tap support, and head back upwards. That is a general standard bit of price action. When there's an excessive amount of fear, we generally see something like this, all right? Or we will see a singular candle wick down and push upwards, because support lines are no longer solid. People are excessively selling into supports, and it gets bought back up and it pushes back upwards. And we can assume exactly the same thing on the flip side when we're talking about excessive FOMO. We see these huge fake outs to the upside to get tapped on resistance and then head back downwards very quickly, okay? So when you're trading in periods of not even massive volatility, but massive fear and FOMO, you have to be a little bit more cautious about where you put your stop losses, just because it is more likely we see these fake outs than what we would usually see in traditional price action or range movements, okay? So taking a look over here, we found a nice strong baseline of support. We pushed upwards, very aggressive push upwards. Of course, breaking through his horizontal resistance here sent us into a parabolic rally, magnetized back to his range, just as we said it would. From here, we did expect a little bit of slowdown in price action. We didn't see that though. The FOMO was strong. In this entire period here, the technicals have been suggesting a weakening in strength of the trend and weakening in momentum. This is where it gets tricky for technical analysts like myself. I base my decisions on technical analysis. I try front run ideas, I try look, and I try perceive the future essentially based on what the data is suggesting. When there is a lot of FOMO, it is very hard to do that, because the trend can, even though the trend is suggesting it's weakening, it's losing momentum, we're losing horizontals, we're not breaking diagonals, we're breaking down, it can continue to go up as it is continuously losing momentum and losing strength. And what can happen, it can reset as it's rising upwards and then see another rally on top of it, and again and again and again. So it gets a little tricky, but let's zoom out, because when you're in doubt, zooming out always helps. So let's go to the 4-hour chart. And the 4-hour chart paints a much clearer picture of exactly what is going on over here, okay? We saw a significant macro structure play out over about a 2.5 month period between July, so June, July, August. And this was our macro ascending channel formation that we counted from the bottom, retested, and finally lost on that Mt. Gox release over here, breaking down. This sent us into a massive tumble all the way down. You know, we saw from that point about a 13-14% drop all the way down, and since then bounced back upwards. Now, even though we are out of this macro structure, the trend lines of these structures are still in play to some extent, okay? The price is outside, but they're still in play. So we're looking at this trend line again, and we can see the price has tapped that level, broken through, liquidated a lot of shorts, came back down, liquidated longs, and now we are sitting in between an area of massive support. Okay, this is an area of big support now for the chart. This is between the 21,600 and 21,800 level. Now, we were talking about this about a few hours ago in our VIP channel, in our Telegram scalping chat, and we took some shorts at 22,000, stop loss over 24,000. We've got some nice profit on there so far, but the next move down, the trigger for the next move downwards would be the loss of the 21,600 level, okay? And we want to see that on a higher time frame, probably an hour chart would be nice, okay? Now, where would we head if that happens? I don't know why I just brought up the text. Let me delete that. We would be heading downwards to this level here, okay? This 20,600, 20,500 level would be that next target purely off price action if we reject from this level, okay? If we go ahead and draw some trend lines in, we can see a short-term uptrending support line over here developing. Generally, when we see these diagonal trend lines like this, we generally do expect break downwards, as this is representative of a channel, a rising channel, or a rising wedge structure. There's no other chart patterns that come from it. Rising channel, rising wedge structures are represented by these sloping trend lines like this. So we do expect a break from this eventually. It'd be very incredibly rare to see, and I mean very rare to see and incredibly bullish to see the price just bounce from here again and continue up. But this is what we've been seeing this entire time, right? We've been seeing these bounces from these trend lines and continuations upwards, which has been very hard to predict and foresee because they're unexpected. They're not common. It is going against the probable scenario. And when trading, you have to go for the probable scenario. But I digress a little bit. Let's go ahead and zoom out again. So let's do some technical analysis, guys, just to kind of figure out, what is the trend suggesting right now? Again, when we have these explosive move upwards, generally the TA is going to be lagging. So all of the TAs are now probably going to start to flip bullish. The price action is suggesting we're bearish. You have to kind of merge the two together and come to your own decision on where the price is going. Because if you're going off TA alone, right now in the smaller time frames, we're looking at the daily, the 12-hour, it's going to tell you we're bullish because it's now accounting for this rapid surge, right? But it doesn't account for the fact that major resistance, we hit major horizontals, we're rejecting from major trend lines, momentum is weakening. It doesn't take into account that. Therefore, it's not telling us what's going to happen in the future. It's telling us what has happened, what is happening, and therefore we need to apply our own analysis and decide what is going to happen. So that's where people get mistaken with technical analysis. They think, oh, I can just type in the RSI or the MACD and now tell me what to do. Well, no, that's not really how it works. Because it tells you what happened. It's not telling you what's going to happen. You have to understand when to use it, what indicators to look for, what trigger points to look for, how to decide when your entries and exits are going to be, what zones you should be taking. You have to infer your predictions with that. So you can't just be like, okay, RSI is here, therefore I'm short. If you're doing that, you're going to be wrong. You have to look for trigger points. You have to look for diagonal breaks. You have to look for momentum shifts. There's a whole range of different things you have to look for. Anyway, I'm digressing again. But let's go ahead and take some looks. So we're going to go ahead and jump over to this chart, and we'll come back and talk about the CPI and all that kind of cool stuff in just a moment. Like I said, today's video is going to be a longer one, guys, so thanks for sticking around if you're still here. But let's go dive into a technical analysis. I like to use this chart a little bit more of a clean slate before we get into it. So, a few things I want to look at, and I want to start on the daily chart because we have had a pretty huge move upwards, right, on the daily. And let's take a look. So, let's start with our VRPV. I like to have a look at the volume ranges just to see where we are sitting. And this is not looking too bad. I wouldn't say it's not looking great, but we do have this little valley here. And if you know already on the channel, you've been watching me use a VRPV for a long time, you know that these valleys are generally low trading, historically low trading volume ranges. And historically low trading volume ranges generally are eaten up pretty quickly. So generally when we push through these ranges, like over here to here, we generally move down these gaps pretty quick. All right, and we can go back in time and look at this. It's happened 100 times. Generally, we move through these levels very fast, okay? And we're seeing a small gap here. It's not a big gap. It's not even a very low trading volume range, but it is a gap in comparison to these peaks. And we generally tumble down these peaks to the next peak when it happens. The only problem is sometimes we can get rejected around these peaks and head back down if that occurs. So what we're seeing here, and what's this telling me here, it is confirming the fact that we've actually pushed into a major resistance. It's confirming the fact that the current zone we are in is a major area of resistance. We can see that on the chart on the VRPR over here. If I can go ahead and draw some lines in, we can see that the moment we get the drop off over here, we'll see that resistance, 21,800 level. Now the 21,800 level is not a random price point. Like we said, 21,800, 21,600, key trigger. If you remember back to August, end of August, we were talking about the 21,800 for at least a week. And we're talking about how we need a daily close over the 21,800 level. This high wick, 21,800 level, to trigger the next move upwards. We're still waiting to see that occur. Hasn't yet happened. Still waiting for that to happen here on the charts. Okay, something to look out for. Let's take a look at the Market Cipher. Now, Market Cipher is just to show us the short-term moving averages. If you want to know what moving averages I'm using, here it is. 4, 15, 17, 21, 26, 28, 32, and 50. 50 being the red line. Okay, so obviously, moving averages are great at telling us the strength of the trend. They don't tell us support, they tell us how strong the trend is. Is the trend positive? Is it negative? Is it going upwards? Is it going downwards? Where are the gaps? Where can we expect the price to move up to? Right now, we're above all short-term time frame moving averages. We're above the 50 moving average, which is nice to see. But generally, when we're above the 50, we are looking at some exhaustion in the short term. If it can be sustained, it can result in a larger move upwards. But if we go to a 2-day chart, you can see that we will be underneath the 50, or at least, yeah, there we go, underneath the 50. So it tells you right now that, you know, we do have some move upwards, we do have some movement room upwards, but right now it is more likely to reject. So let's go to the 1 day again and bring up our bull market support band. We are over the bull market support band, but once again, bull market support band is really a useless indicator on the smaller time frames. We want to be using it on the 3-day plus. Here is the important things. Look at this rejection. The 3-day plus bull market support band, we can see a rejection from that, and look at the pinching on that bull market support band, the flipping on the trend over here. We have, it almost looks like we're pinching red crossing green, which is obviously a bearish thing, but it looks like we are pinching the price. We'll need to get above over that for us to flip any sort of bullish in the short term, which is nice to see. Let's go ahead and take a look at the RSI. Now, the RSI had our macro descending wedge formation on the 3-day. We can go ahead and draw that one in, and we did actually break out from that one, which is really, really nice to see. Obviously, we get these breakouts. It does indicate we have positive momentum, and we do need this positive momentum, of course, to trigger any moves upwards. As price moves on momentum, this is probably the most bullish thing, sorry, I can't speak, we have seen on the chart for a while. This is incredibly bullish and not to be underestimated. Once again, guys, it is hard to say for sure if this move is manipulated or not. We have a lot of data coming out this month. CPI, Fomo, Mt. Gox, Ethereum merge. We have a lot of stuff coming out this month that could either take this price, run with it upwards, or flip this entirely and crash us back down. So we're going to talk about that one in a sec. We're going to talk about that in a second, but keep in mind, guys, right now is not the time to be aggressively entering. Right now is not the time to be panicking and jumping in for your money. Be a little bit more cautious now, because even if you buy $1,000 higher, you're not missing out on much in the grand scheme of things. But if you buying $1,000 higher is saving you a 20% risk or a 10% risk, it's so much more worth it, okay? Focus on the process over the profits. If you're focusing on the profit, you're gonna end up making risky decisions that do not pay well, and you'll end up losing over time, okay? Let's take a look at some other indicators, and of course RSI was looking great there. Let's take a look at the MACD, and I don't really like to use MACD, but we'll take a look at it on a larger time frame. Let's go to a 7-day chart and see what we're looking at on the 7-day. We can see we had a crossover, nothing too amazing here. Volume picking up, no signs of reversals yet on the MACD. We're waiting for a light shade of green candle to flip. Now this is good. We're seeing this conversion point at the bottom. It's very, very oversold on the MACD. You can see we have some sort of cross maybe potentially incoming, but I wouldn't hold your breath on it, because we saw a cross happening over here. It didn't happen, so very important to keep in mind. And finally, let's go ahead and take a look at the Ichimoku cloud, as in the last couple of days we've had a significant move upwards, and it could be triggering something. On the 10-day, we can see that we're crossing over conversion. Nice to see. 1 week, again, crossing over conversion, kind of sitting around the conversion line level. 3-day chart, same kind of thing, baseline conversion crossing, which is good to see. We've got the lagging span just pushing through the price action now, slowly coming through. Finally on the 1-day chart, we are getting rejected from the clouds. Again, nothing too massively important here. We would like to see a price action push through the clouds, and that would be sitting around 23,000, okay? Let's go back to our standard chart and talk about the short-term price action movements, and then we'll go ahead and talk about the CPI. So, like we said already, guys, drop below this uptrending support line, we will lose 21,600. That will trigger the move downwards. Simple as that. No need to overcomplicate it. That is really as simple as that. We lose 21,600, we lose this uptrending support line. I am looking for shorts. I am going short. I am expecting lower prices. I do not think, however, that this could trigger a cascade effect to new lows. Maybe it will, maybe it won't. We have to wait for CPI. It's too early to say that for a fact, but I do think this is the next major horizontal support zone. If we do lose this level up here, it is more likely or not we come down very close to or actually at this support level here, okay? Moving upwards from here, it gets a little tricky since we're pushed upwards a lot. We haven't found much support. We're in a support zone here. We haven't really claimed that support zone on the larger time frame. On the smaller time frame, we've claimed it as support. We go to a 4-hour plus time frame. It's definitely not support yet. We're still challenging that support zone. Pushing through this level on the larger time frame will be good. Closing a daily candle above 21,800, a solid daily candle above 21,800 would be ideal for a move upwards, and our target would be this range here, okay? That is it for the analysis, guys. I'm going to talk about CPI, and let's go ahead and bring up the CPI, because the CPI is coming in a couple days. I've got the picture over here. Hopefully you guys can see that on the screen. This is our last few months of the CPI, and you can see that our previous was 8.5, right? And that was for July. August is coming in, and you can see the date over here, 12:30, and I think this is Washington DC time, the 13th of September, which should be in maybe 48 hours. I'm not exactly sure. I'm in Australia, so I don't know the time exactly, but it should be in about 48 hours, or maybe 32 hours or something. And we have the consensus around 8.1%. So people are expecting, or it is expected at least, that 8.1% is expected, or the CPI should be 8.1%. We're going to talk about that because CPI and risk asset prices, strength of the dollar, Bitcoin, all that kind of stuff is really tied in more than you think. And I want to talk about it using two charts. And the two charts I want to use to discuss this is this chart here, which is a systematic risk chart, and it looks complicated, but we'll talk about it in a second, as well as this little flow chart here, which is the connection between inflation, cost of goods, asset prices, all that cool stuff. And I also want to talk about the Fomo coming up on the 21st and discuss the interest rate hike that I think they may apply to the CPI, to inflation rates going forward. Now, I'm going to say this. If CPI comes in lower than 8.5%, I think we might see a 0.5% basis point hike when the interest rate hike is announced. And the reason I say that, I'm going to try to find a post. I actually talked about it. Give me 1 second to try to find it. I talked about it. Sorry guys, I'm just trying to find the post. I talked about this one actually in another video I did the other day, and I can't quite seem to find it. Let me see if I search this up. Here we go. Here it is. So we have, I'm just going to show you on the screen over here. This was from the Fomo Minute meetings last month in July. And a quote from that was, nearly all respondents to the desk survey anticipated a 75% or 0.75% increase in the target range at the current meeting, and most expected a 50 basis point increase in September. So the 50 basis point increase for September is not off the table. It's definitely on the table. It is a possibility that they're actually considering. And I think that if CPI comes in lower, we might see a 0.5. But again, speculation. So to talk about, or to get you guys to understand how CPI, and we've done this so many times already, but for the new viewers, how CPI actually impacts asset prices, or how CPI impacts cryptocurrency, which is what we're here for, we need to understand the correlation between inflation, interest rates, and asset prices. When we understand that, we can go to our other chart and then factor in systematic risk, factor in different rate changes and inflation, and then talk about how that's going to increase price. So let's talk about it. Inflation increases, simple as that. If inflation increases, interest rates will rise, and this is a tool to reduce inflation. So they go the same way. They're positively correlated. When inflation increases, interest rates generally rise to combat that inflation, okay? When inflation is increasing and interest rates are rising, interest on debt increases, okay? So you're paying more interest on your debt. You've seen housing prices, mortgage rates go up. You know, you've seen rates on loans go up. The debt obligations people have, they increase. They're paying more money to that. Now, this affects companies and it affects retail differently, because in the market you have entities that purchase, such as companies, okay, and then you have retail. There's two different fields, and it affects us differently. So we need to talk about it differently, because the way we invest is different. Household, so retail investors generally don't take loans to invest. They generally use their available cash flow to invest. So if interest rates are rising and inflation is rising, how does that affect us? Well, costs of goods are rising. So the expenditure for living, the living costs are rising. Maybe unemployment is going up. Maybe people are losing jobs, right? There's all things that have already happened, okay? The fact is that retail have less available cash flow to invest, or that their required cash flow to live increases, both of which results in retail selling their assets and therefore the prices falling. Now for companies, they acquire a lot of assets, risk assets, on debt. They take a lot of loans on low interest rates to acquire these assets to increase their balance sheets, to increase their future cash flow earnings, all right? Increase their balance sheet cash flows to make their companies look more favorable. What happens to their stock prices? The stock prices inflate massively. Now, they've been taking a hell of a lot of debt on during the last, few years when inflation, interest rates have been very, very low. That's why stock prices have, flown up to the moon, okay? Now, when interest rates have risen, a lot of stocks crashed massively as the reverse effect happens. They now need to sell off their asset sheets, balance sheets. They need to reduce their exposure so their debt obligations decrease, their cash flows decrease, and money flows out of the market. This is what we've seen. Now you understand the connection between everything. We can talk about how this is going to impact the crypto market going forward, because here it is. If inflation comes in lower than expected, it is anticipated that interest rates will not need to be raised as aggressively to counter inflation. Therefore, this entire process is closer to reversing. Okay, it makes it. If you try listen to it again, it'll make it a little more sense. But I'm going to explain it in a lot more detail in a second, because we need this chart to talk about it. We really need this chart to talk about it. So the market moves. When we talk about the market, we're talking about financial markets. We're not talking about housing markets. We're not talking about cost of oil, or we don't care about that. We're talking about cryptocurrency, stocks. And for this channel, cryptocurrency. We're talking about risk assets. Risk assets generally, not always, generally move on perceived systematic risk. I'm going to talk about systematic risk. What is that? Systematic risk is the risk in a market that you don't have control over. So, such as inflation, monetary policies, interest rates, tax policies. They're the risks that you don't have control over. Okay, there's the risks that every market participant, except Nancy apparently, is exposed to. Okay, we are exposed to these risks. Now, as inflation increases and interest rates rise, systematic risk starts to rise. The return on the investment decreases for higher risk. Like we see this on the chart over here, okay? So this is our risk-free rate. This is the return at zero risk, okay? And we can see it lines up over here. This is basically our return. So as systematic increases, we get this increase, the return stays the same, okay? But the risk increases. So see how the return is still the same. This is the return, okay? It's still the same. And this is our risk. The risk increases. It pushes down this way. So the risk on the same return is increased. Now, generally when the risk reward ratio shifts to a negative or less favorable, you want to get rid of your asset. You don't want to hold that. You want to sell it. That's exactly what's happened. Okay. Now, this is the interesting thing. If we flip out increased systematic risk and change it to decreased perceived systematic risk, we get the opposite thing happen. So generally markets move based on perceived risk. Now, what is it? What is perceived risk? Perceived systematic risk is that when the market participates or expects inflation to be near the top or about to top out, the systematic risk perceived systematic risk decreases. We don't actually need to see inflation top out. We don't actually need to see the economy reverse. We don't actually need to see the economy bottom. All we need to see is the perception that it is close to the top, and straight away the perceived systematic risk decreases, the return on the investment shifts, and asset prices increase. That is exactly what we have seen occur this entire time here. That is exactly what this entire period has been. That is exactly what we've seen. Okay, it is as simple as that. It is all linked. If you think it's not linked, you got some learning to do. Everything is connected. Now, if we're talking about this recent pump, I do believe a lot of this was manipulation. I believe a lot of this was FOMO. I think a lot of it was greed. It pushed up faster, quicker, more aggressively than it should have. Not natural, but we're excusing that for now, okay? We're talking about the CPI. So now if CPI comes in lower than actual, because it's meant to be 8.5, right? If it comes in lower than 8.5, that would be a good thing, right? But the forecast is 8.1. So here's where it gets tricky. Would the perceived systematic risk increase if it's between the forecasted and the predicted, so 8.5 and 8.1, or will it drop? Would the perceived systematic risk increase or drop if it's under 8.1? So there's two answers. If it's under 8.1, incredibly bullish, market goes upwards. If it's above 8.5, incredibly bearish, market goes down. If it's between 8.5, 8.1, it's a little bit tricky because we've got a situation where it is now higher than what's predicted, but lower than last month. And we've talked a lot about this already. Perceived systematic risk is what moves the market. So if it's lower than last month, but higher than predicted, that should theoretically decrease the price of assets. We should see the prices go down. And this is why I'm a little bit worried moving forward into CPI. I don't want to front run it too much. I'd rather wait for that to come out before I get into the market. I'm already in. I bought at $18,000. We all bought at $18,000. If you're watching a channel, you bought 18K. You're a profit. But to go more aggressively in the market, I'm going to wait because I don't want to be front running this. This is a pretty big drop. 8.5, 8.1, pretty big drop. Considering the previous came in at 9.1, that'd be a whole 1% drop in a month. That's pretty big for interest. That's pretty big for inflation. That's a pretty big difference, guys. So if to get 8.1 and lower, that's over a 1% drop. That's pretty significant. And I don't think we're going to see that. I think we're going to see maybe 8.2, 8.1. I don't know if we're going to see above 8.5. I don't know if we're going to see it below 8.1. But time will tell. And regardless of what happens, we now understand how the price will move. And therefore we understand what to do when the information drops, how we can capitalize on that. Now, if you've been part of my VIP channel, you will know that every single month we have capitalized on CPI. There has not been a single month this entire year where we have been on the wrong side of CPI release. Every single time CPI release comes out, we get on the correct side of it and we profit on the way up. Every single time, it's because we understand how economic data influences price more than just up, down, up, down, up, down. We understand the backbone. We understand where the money flows from, how it flows from, why it flows from, and what things mean and how they're connected. Anyway, guys, I'm gonna leave it there. I hope you enjoyed the video. If you've got any questions, leave them down below. It's a longer video. If you've made it to 38 minutes, let me know down below. Say you made it to the end. That's a big achievement because I've been talking for 40 minutes now. I'm tired. I'll be tired watching a 40-minute video, but I hope it's been beneficial. I hope you feel prepared for the news coming out. If you appreciate the channel, appreciate the content, guys, drop a like, drop a comment. Sign up to Bitget, trade on Bitget where I trade. It supports the channel. I get a little bit of commission from there. It always supports me. And if you're interested in learning how to trade like I trade, if you're interested in learning not only how to trade, but how to do analysis like I do analysis, sign up to the Become a Trader course. And of course, if you want my trades, VIP is where it's at. That being said, guys, I'll see you guys in the next video and be sure to watch the credits at the end. Cheers. Okay, guys, we're going to be taking a quick look at Bitget. And now Bitget is where I personally trade. I highly recommend signing up to Bitget with the link down below. Bitget is probably the best exchange out there if you are a trader. It has a variety of features, and the best things about Bitget are a few things. Number one, it's non-KYC. Well, KYC is completely optional on Bitget. Now, there's a whole variety of exchanges out there nowadays that have gone completely centralized, sharing your personal trading information and information of decentralized governments and different governing bodies. Bitget allows that option to be left to the individual, to the user of the exchange. You can decide to non-KYC, you can decide to KYC. It's completely your choice. Another really beneficial thing about Bitget, and the biggest reasons why I'm sitting here actually recommending Bitget to all my followers, is that it has 0.02% trading fees. All right, this is significantly lower than any other cryptocurrency trading exchange out there. FTX, Binance, can name a bunch more, KuCoin. It is significantly lower, by 500% lower than the lowest exchange out there, Binance. Another big thing, guys, is there's no global restrictions on who can use Bitget. Anyone from anywhere can sign up to Bitget and get access to the entire exchange of all the tools, whether it be futures or spot. No matter which country you're in, you can use futures and spot. If you're in America, for say, and you want to get access to more spot trading pairs, such as Binance Global, and you can't sign up, well, guess what? They've got 250 different spot trading pairs here on Bitget to get access to, and you can get access to all of these. If you're in Australia and you want to access the futures market and you can't trade futures, you can do it here on Bitget. You can get access to the future market and start trading with leverage. And finally, guys, if you do want to sign up to Bitget, go ahead, click that link down below to sign up to Bitget, and you'll get access to the reward center over here, which enables up to $4,000 in rewards by completing 5 tasks. All right, guys, we'll get back to the video. Thanks for listening to that. Okay, guys, I want to take a quick moment to introduce the Become a Trader course at the end of this video. This course was designed by myself and Wolves of Crypto. We put together a whole variety of knowledge to create the most cohesive, understandable, and beneficial trading course there is on the market. If you're interested in learning how to become a trader, if you're interested in learning how to use technical analysis, if you're interested in learning how to apply market analysis to different cryptocurrencies, this is a course for you. We teach you everything from the fundamentals, the basics about what cryptocurrency is, how to trade cryptocurrency, mastering the craft of cryptocurrency, diving into a whole range of technical indicators, market structures, and teaching you how to utilize these when finding trades and applying risk management strategies to become more profitable over time. We even dive into market psychology, human psychology, and provide a variety of different videos and educational content, including courses and quizzes to assist your learning along the way. If this is something you're interested in, guys, go ahead and contact us down below at the cryptoacademycourses@gmail.com. We'll send you an email back with all the course information, the structure, the payment details, and everything else you need to know. That being said, guys, I hope you enjoyed the video today, and we'll catch you in the next one.